Hey folks, welcome to a product review at Finominal. Today we're going to look at Evoke's risk parity ETF that trades under the ticker RPAR. Now, risk parity is an asset allocation framework that tries to allocate the same risk across asset classes. And this was pioneered and popularized by Bridgewater Associates, which is the world's largest hedge fund. And for a few years, there have been a few ETFs, and RPAR is the oldest one amongst those that effectively provide exposure to all investors to this asset allocation framework. So let's have a quick look in terms of how well this asset allocation has done. And the first thing we're going to do is a benchmarking exercise. So our alpha analyzer tool is suggesting the S&P target risk conservative index as the appropriate benchmark, which is a kind of like 60-40 version that allocates the bonds and equities. Now, what we do see that effectively we have a tracker of around 4.5 years, and that the R squared of RPAR to the index is 0.81. And it's much higher than, for example, compared to the SP 500, given that RPAR invests in different asset classes, not just equities. Now, from the performance perspective, we do see that RPAR versus that S&P target risk conservative index has broadly exhibited the same trends, but has not particularly outperformed. There were short periods, but those are periods of underperformance. Now, in terms of what the right benchmark for risk parity product is, it's a little bit tough to say. There's no, I think, right or wrong answer. You can take a 60-40 portfolio, but that ignores a little bit the risk associated with asset classes. But what we can do is we can look at how the product has done in terms of factor exposures over time, if it has provided what we would expect it to do so. And so returns-based factor exposure analysis shows effectively the effect of betas across asset classes. And we do see that this was a consistently positive beta to bonds, consistent positive exposure to S&P 500 or equities, as well as commodities, and slightly negative exposure to the US dollar index. But that's from a beta perspective, and the beta is a function of how volatile the underlying index is. And so bonds are less volatile than stocks, so the beta is higher. More important is if you look at that from a risk sources perspective. And as mentioned, risk parity aims to provide the same risk exposure to asset classes. And that's not necessarily what we see over here. So we do see that the exposure to bonds was, significantly more over time than to equities or currencies or commodities. Now, this may be a function of RPAR allocating to different types of bonds. So for example, there are long-term treasury bonds. There's also TIPS, which are inflation-protected securities. Equities is actually the lower allocation. So to a degree, we shouldn't expect that this is like a 25% split across all those four asset classes, because that's a perspective that we're sharing in terms of how to analyze risk. And then it actually depends in terms of how RPAR is doing that. Having said that, what we can do is we can try to replicate RPAR. And so what I've done on my dashboard, I've created an RPAR replication where effectively I've taken long-term treasury bonds, I've taken TIPS, MSCI, ACWI, commodity producers, and gold. And RPAR leverages its portfolio to 120%. In this case, I'm going to ignore that, and I'm going to simply use an unlevered portfolio. Now, what we can do next, we can simply compare how RPAR has done to this very simple replication. And I'm going to do that on our portfolio diagnostics tool, where we have a track record of close to 5 years since RPAR was launched. We can see that the RPAR charges 48 basis points compared to this replication of 25 basis points. And again, just for confirmation, right, we see the holdings here, right? We see RPAR just 100%, right, versus these relatively cheap ETFs. And from performance perspective, it's actually quite interesting that the replication, which takes the same weights as RPAR, just like it doesn't have the 20% extra leverage, it actually has outperformed RPAR. And not only in the times when the performance is positive, so it's actually not explained by leverage. That's kind of interesting to think about. Now that's RPAR versus simple replication, right? So if you want to replicate that, you can do this quite easily. There's nothing complicated about that. The other part is, how does RPAR compare to its peers? Now, I've selected 3 other products that focus on risk parity. There's one from PNB, Wealthfront, and Fidelity. It is worth mentioning that the track record is very short, because I think PNB has only been launched a year and a half ago. So we only have like a track record going back to January 2023. Now, what we do see that these 4 products, they kind of broadly exhibited the same trends. Having said that, we also see that RPAR underperformed under that period. And that gets more interesting if you look at that from a risk return perspective. So here we see effectively that from a return perspective, BMW has done quite nicely, or PNB, my apologies for that, versus RPAR has effectively generated the lowest return with the highest amount of volatility, which of course reflects the lowest Sharpe ratio. Now, it is worth mentioning this is only 1.5 years, so we can perhaps disregard that. What we can do, however, one of these products, the one from Wealthfront, that has a longer term track record. So we can simply compare RPAR versus the product from Wealthfront. And here we have performance going back to 2019. So this is roughly almost 5 years. And over that time period, we actually do see that RPAR has outperformed. I've also added the 60/40 portfolio here from BlackRock. As you can see, that actually has done better for that time period. Now, the one interesting aspect about this is that effectively a lot of the decline in the Wealthfront product can be attributed to the COVID-19 period. And if we just see like a change of time frame here, let's say to early 2022, let's see how that changes. Then I think these products become much more similar. And here you can see almost no difference between the product from Evoke versus the product from Wealthfront. Now, that kind of concludes our product review of RPAR. Now, you can look at the performance over here and can argue it has underperformed the 60/40 portfolio. Sure, but the asset class is also different. RPAR does have exposure to tips, to gold, to commodity producing stocks, and so on. What's kind of surprising about this is that RPAR does have that inflation angle with this 35% allocation to tips, and inflation has been high over the last 3 years, but that does not reflect in a better performance, for example, at 60/40 portfolio. And of course, you could attribute the 60/40 portfolio to the 60%, i.e. equities, which makes this a little bit complicated to think about. Now, in terms of thinking about risk parity as an allocation model, there is a lot of them. There's equal weight. You can think about other ways of weighting by risk, and there's lots of research on that. So we're not in a position to either say risk parity is good or bad. We can look at the performance over the last 5 years, and that's not particularly impressive in that product. The one point that we would like to make that we also published in research is that if you look at the performance of risk parity, which historically meant leveraging bonds, that of course has become far less attractive in an environment where rates went up over the last 4 decades. We can largely attribute the stellar performance of risk parity products, like the fund from Bridgewater Associates, to an environment of declining yields, and that has certainly changed. So if you look at the history of risk parity products, then that is certainly not what you should consider going forward. I hope that helps. Have a nice day.